Welcome everybody to today's webinar, SMSF expenses under the microscope. I'm Tim Miller, the Technical and Education Manager at Smarter SMSF. Glad that you could all join me for today's session. So, look, what I wanted to really get across with regards to today's session is that there's been a lot of activity in the SMSF space, particularly around expenses, because we've had this long drawn out process, basically 5 years now, with regards to non-arm's length expenses, and we've now got legislation that's been introduced into to Parliament and has been through its first reading, which introduces the mechanism for self-managed super fund expenses to trigger non-arm's length income, and I'll touch on that through today's presentation. But I thought that was a good opportunity for us to look more broadly at SMSF expenses in general, and look at the deductibility element of such of those, or of many of those expenses as well. But also, given that a lot of expenses that an SMSF might incur are of a capital nature, I thought it's also worthwhile highlighting that these gnarly rules that come into place, particularly around general expenses, which impact the entirety of the income of the fund, they will apply whether they are expenses of a revenue or a capital nature. So we need to be mindful of that as we go along. So there's a fair bit to get through, because I want to sort of focus on or try and touch on every style of expense that we largely see in the SMSF space. So it's going to be a relatively fast-paced session, of course, as always, with the disclaimer that the presentation is put together based on understandings as we know it right now, and in particular with regards to the gnarly provisions, the legislation hasn't been finalised. It's been introduced, and so we'll watch it work its way through the House, but we would expect that it will go through sort of untarnished, which is largely disappointing, I guess, in the SMSF space, given that it is exclusively focusing on self-managed superannuation funds, but certainly would expect that those measures will go through. So hopefully by the end of today's session, there'll be a bit of an understanding of the types of expenses that a self-managed super fund might be liable for. And of course, we can't go through every style of investment in this sort of time frame to work out every type of expense, but certainly go through the vast majority of them, have an appreciation for the deductibility of various expenses, and then how the gnarly and ECPI elements associated from an income point of view can impact various self-managed super fund expenses as well. So as you can see, a fair bit to unpack there. We'll start off by looking at a number of the expenses and the deductibility, and then work through some of those insurance and apportionment issues as well. So let's start by looking at the deductions associated with SMSF expenses and the various deduction types that will apply. Now, I'm going to sort of try to reduce, I guess, the technicalities of the session. I've got lots of references in here to various sections, which by all means go in and review for yourselves. But I'm not going to try and get bogged too deep into the legislative references, other than to say that obviously that we have our general expenses, and then we can often have deductions that are based more specifically on other sections inside the Income Tax Act, which along the lines of such things as insurance, which we then need to be mindful of. So basically, if we start at the very base level, we've got our deductibility of expenses, our general principle, which is expenditure incurred by the super fund under Section 8.1. So this is our primary deduction area from an SMSF point of view that we go to. So unless a specific deduction provision applies, and I've got there the tax-related expenses that are deductible under 25.5, but as I also highlighted, other things such as insurance, which we'll touch on a little bit later. So as a general sort of principle, most of our deductions are going to apply or occur under that Section 8.1 of the Income Tax Assessment Act. And then any losses and outgoings relating to exempt current pension income are generally not deductible, because they're incurred earning exempt income. And of course, when we talk on exempt income, and segregation in itself is its own webinar, but when we talk about ECPI and segregated versus unsegregated or pooled investments, then clearly what we would do is, in a sense where a fund is 100% in pension, then generally most of our deductions are not going to be deductible, because one, there's no need because there's no income for the fund to receive. But when we talk about apportionment, so when we talk about having a pooling effect for our assets from a pension point of view, we can look at multiple ways to do the apportioning, and I'll touch on that a little bit later. But if we've got a mixture of accumulation and pension, then yes, we still need to look at the deductibility of expenses to determine whether or not those expenses need to be apportioned from a fund taxation point of view. So if our expenses are deductible under the general provision, and the fund does have pension and accumulation, as I said, then those expenses are going to be apportioned. And TR 9317, basically that provides the general principles regarding tax deductibility for the expenditure incurred by a super fund. And for those of you that have been around the industry long enough, you may recall that I reckon probably 2006, but it's certainly around that time frame. The tax office released a ruling, an income tax ruling, to try and replace this TR 9317, so to effectively update it. But going through that process, what they ultimately ended up doing was adding more additional information to 9317. So we never had a replacement. We had drafts of replacements and alternatives for apportioning from an expense point of view, but we've settled and retained 9317 as the go-to tax ruling with regards to the deductibility of expenses for self-managed superannuation funds. So it's always a handy reference to have on file there. So when we're talking about expenses, right, and again referencing the apportioning rules, then normally we'll find from an ordinary point of view, from an ordinary sort of sense, from a self-managed super fund position, normally the deductions that we'll see will be our operating expenses, our investment-related expenses, various tax-related expenses, legal expenses, statutory fees and levies, then our income protection, death benefit, so our insurance-based expenses as well, and then expenses associated with our collectibles and artwork, because we know that there are rules around holding collectibles and personal use assets inside super fund, and one of those rules incorporates things such as storage and insurance, and so therefore the expenses associated with those types of investments would typically fall under the general expense category for a self-managed superannuation fund. So I want to work through a number of these expenses, and then where necessary highlight some key issues linked back to particularly the non-arm's length expenditure issues associated or that self-managed super funds need to be aware of. So to do that, let me take you through where we currently sit with these NALE amendments, because as I said, as a matter, it's been going on since 2018 or actually prior to that. And despite consultation, and despite many of us being involved in the consultation, we got to a position where our preference would be the position that they've applied for APRA funds, which is that there will be no NALE applied from a general expense point of view, but there will still be NALE associated with specific fund investments. So we've got to be mindful of how that operates. But what we saw was that in September, the government have finalised their position. So we've had consultation that's been going on for a couple of years there, and the tax office, the Treasury have finally released Treasury laws amendments, and it was support for small business and charities and other measures. So again, as often we see, they shove potentially the unpopular elements of legislation in amongst some other quite positive measures to potentially push them through Parliament. But we had the legislation introduced, and what it did, it took us from a position that we know that when the ATO released LCR 2021-2, which was the finalisation of the law companion ruling that was released back in 2019, we know that it was hugely disproportionate outcome if you had a breach in relation to a general expense, because what we recognised within that original ruling and then the LCR 21-2 was that general expense had effectively a nexus to all of the income of the fund. So, an underpayment of an accounting fee could be hugely detrimental to the fund and result in the entire fund income being taxed at 45%. So that was just sort of unfathomable. None of us really expected or hoped for that to progress any further. The government then, I guess, made a slight change. It came out of the blue. It wasn't something that the industry was necessarily expecting, but they introduced this 5 times expense factor. So they looked at it and said, okay, well, whatever the shortfall is between the expense that you pay and an arm's length expense, let's times that shortfall by 5. And if there was a 0 expenditure paid, then it was like apply whatever the normal arm's length expense rate would be, multiply that by 5, and that will set your income for determining how much of the income of the fund was going to be treated as non-arm's length income. So that was a huge change, and indeed a huge benefit, from all of the income being taxed at 45% to 5 times the expense rate being taxed at 45%. And then we got our post-federal budget consultation, and that's what resulted in this final piece of legislation, which ultimately introduced a 2 times expense factor. So really where we've landed, whilst we might not agree with the approach and the fact that it's only applicable to self-managed and small APRA funds on general expenses, where we've landed is a position where if an expense is relating to a specific fund asset, that the income derived from the asset, including the capital gains, is going to be taxed as non-arm's length income. And I'm going to talk a little bit about capital gains shortly as well. But with general fund expenses, right, we know that the ATO have not allocated any compliance resources up to 30 June 2023, based on what they put in the previous PCG 2020/5. But from the 1st of July 2023, we've got to have an appreciation that when we're dealing with a lot of these expenses in a general nature that we talk about today, that if we don't pay an arm's length rate or an amount for that, right, then they will look at a 2 times difference of being the amount that you would be expected to pay if it was an arm's length arrangement. So again, from an income point of view, it's a far better outcome than 45% tax on the entirety of the income of the fund, but it still, creates unnecessary burden, I suspect, on many SMSF trustees with regards to the expense rates to justify the arm's length nature of them. And I'm going to touch on a few of those as we go through. But if we use this as our sort of underpinning logic for determining what the appropriate expense rate is, knowing that the worst case scenario in most circumstances, if we're not paying an arm's length element, is to multiply that by 2 and pay 45% tax on that amount. So again, as I said, not terrible, not brilliant, but something that I suspect that we're going to have to live with moving forward. So that's when we're talking about our general expenses. If we're touching on our investment related expenses, which of course will then come back to the specific nature of NALI, and therefore if an expense relates specifically to an investment, then it's going to only apply NALI to the income associated with that investment. However, investment related expenses can be a little bit more broad, from not only a deductibility point of view, but also a NALI point of view. So if you're getting investment-related expenses, or if you're incurring expenses across the entirety of your fund portfolio or whatever, so from investment advice type fee or investment management fees, if there's a shortfall there, then that can be applicable across all of the income of the assets are tarnished by that, or specific investments. Let me a little bit tongue-tied there. If you've got investment expenses associated with the overriding assets of the fund, so all of the assets of the fund, and it's considered to be general, then you're only going to have 2 times that expense nature. But if it's an investment related expense specific to an asset, such as a limited recourse borrowing arrangement or something else, then it's obviously going to only occur, or only going to apply NALI to the investment income linked to that asset. So again, the nature of investment related expenses, you might have investment or interest expenses, ongoing management fees or retainers paid to investment advisors, cost of servicing and managing an investment portfolio, bank fees, rental, property expenses, brokerage fees, the cost of advice to change the mix of investments, whether by the original or new investment advisor, provided it does not amount to a new financial plan. And this is where some of the issues associated with investment related expenses come down to determining then deductibility is if that investment advice is effectively around the provision of advice to the self-managed superannuation fund, then that is an expense that is capital in nature, is not going to be deductible. So again, there's a lot that we have to be mindful of. If it's revenue in nature, then it's going to be deductible. But in certain instances, and there's a number of ATO interpretive decisions around this that will highlight that if you go out and seek investment advice, right? So if you get your statement of advice, or you actually get specific advice around a particular asset, then that will be a capitally incurred expense and will not be deductible to the fund. So a couple of examples there. So John and Penny, trustee of the Smith Family Fund, they decide to seek advice of an investment advisor as to what, as specified in the fund's investment strategy and permitted by the governing rules of the fund, so what listed securities they should invest in the superannuation fund. The cost of the advice as to what listed securities to invest in are deductible, as it's part of the ongoing maintenance of the current investment strategy and not part of a new investment strategy or plan. So again, it's really having that ongoing advisor fee, which is effectively a maintenance-based fee, is going to be deductible. But if you go out and seek further or new advice to create a new plan for the fund, then that's going to be capital in nature, and it's going to be problematic for the superannuation fund. So just a couple of things to be mindful of there. As far as issues such as borrowing expenses are concerned, right, and so again, to utilise a part of an example here, so if an SMSF engages a legal firm to set up a trust to hold an asset that the fund intends to acquire under limited recourse borrowing arrangements, obviously in accordance with Section 67A of the SIS Act, right, then Section 2525 of the ITAA 97, right, provides a specific deduction provision which enables a taxpayer to deduct expenses incurred for borrowing money to the extent that the money is used for the purpose of producing assessable income. So the borrowing expenses that would be deductible under 2525 would be the loan establishment fees on obtaining relevant valuations, cost of documenting guarantees required by the lender mortgage insurance, and fees for the property title search and filing the mortgage documents. However, the cost of establishing a trust for an LRBA are not considered to be a borrowing expense because they're incurred for establishing the arrangement through which the borrowing occurs, not for the borrowing itself. So therefore, self-managed super funds can't claim a deduction for the legal expenses associated in setting up that trust. And also those trusts, because of the capital nature, are not deductible under the general provisions of 8.1 either. So we have to understand that there's a lot of pieces, for example, under a limited recourse borrowing arrangement that go into the establishment, and not all of those pieces are going to be deductible to the fund. And so whilst I touch on those investment-based decisions, so investment-related expenses and borrowing-related expenses, it sort of brings me to this TD 2023-1, which is our NALI and CGT interaction. And I really wanted to highlight this because when we talk about expenses, one of obviously the biggest expenses associated with a fund is going to be the acquisition of an asset from a related party. And so what the tax office did in and around June is that they actually released this tax determination to determine how the NALI and the CGT provisions are going to interact in determining what's going to be statutory income from a NALI point of view, where that capital gain has arisen because of non-arm's length dealing. And again, from an example point of view, from referencing LCR 2021/2 there, the issue associated with underpaying for the investment, because what we know is that we have to utilize the market substitution rules and we have to replace whatever we paid for it with what we should have paid for it to determine what the capital gains tax will be. But in doing this, and I know this is a little bit away from the expense piece, but it sort of all links back from a taxation implication of not paying the right things from an expense point of view up front. Our calculation of the net capital gains is done in accordance with the method statement, which we've got in 1025 of the Income Tax Act, and that's relevant for calculating statutory income for NALI purposes, but also tax payable for the super fund. And so what the Tax Act determines, right? And then what this interpretive, or what this tax determination also highlights, is that our NALI amount can't exceed the fund's net capital gain. So when we're working out what the NALI amount is, which is the gain attributable to the asset with the non-arm's length expenditure, it can't exceed the fund's net capital gains. So what it actually means is that when we've got non-arm's length expenditure linked to a specific investment that we then subsequently sell from a CGT point of view, it has the capacity or the likelihood of tarnishing the entirety of the net capital gains for the superannuation fund. The flip side is if we've got losses, we can offset the net capital gain or bring that down to nil, and there would be no NALI payable. But we have to have an appreciation that the way that the calculation is done means that it's going to impact the net capital gains. Now, what has been recognised by the industry is that this is how the law was written before all these measures came into place. So the law and the way the ATO are necessarily interpreting the law isn't incorrect, but what industry has done, the SMSF Association sort of leading this space, but also the joint accounting bodies sort of jumping on board as well with regard to this, is they've highlighted we have already the mechanics in place under ECPI to deal with apportioning the net capital gain from a tax-free and taxable point of view, from a tax deduction point of view. So why can't we then subsequently apply that from a NALI point? So to give you an example of how this works, and this is the example taken basically from the determination, but then expanded out to give the example of what the association and others are suggesting. So Anya is a trustee of her self-managed superannuation fund. It's got a $500,000 arm's length gain and a $2 million non-arm's length gain. The gain would have been 1.3, but we've done the uplift there. The other assessable income of the fund is $883,000, which is not a capital gain. Current year losses of 200,000. There's no carried forward losses. So the net capital gain after we've done the market valuation substitution is $1.8 million. So in an arm's length environment, we have 1.3 and 500,000. So we've got 1.8 million. We subtract the 200,000 capital losses. And then we subtract the 533, which is our discounting, our 1/3 discounting on the gain, gives us a net capital gain of $1,066,000. There is a nexus between the expenditure and the gain, and we know that the NALI gain cannot exceed the net capital gain. So therefore, NALI is that entire 1,066 million, which of course incorporates that 500,000 or a portion of that 500,000 arm's length gain. Our tax payable is on the entire tax income of the fund. Non-arm's length component is the 1 million at 45%, and the low rate component on the $883,000 of 132. So what the industry have gone back and said is, okay, well, if we use that same example, then if we know, for example, that under, say, ECPI, we can get the actuarial certificate to determine what level of the fund is paying is taxable and what is not taxable, then what we can actually do is we can actually look at the two gains, so the 500,000 and the $1.3 million, and we can determine that as a percentage, so 27%, well, let's call it 28% versus 72% of the total gain, then go through and do our normal calculation to get a net capital gain of just over that $1 million. And then on that net capital gain, we apply a proportioning to get to the 72%, which is then taxed at NALI, and the 27.78%, which is at the low rate 15%. So ultimately what we're saying is that you've already got the mechanism through the existing income tax law with ECPI to be able to apply proportioning. So why don't we do that? Because whilst what they've said in this determination is correct, there's an element of fairness that we're saying, well, perhaps that if you apply this approach, it's going to be more appropriate from a superannuation fund point of view. So I just wanted to highlight that, so that because when we talk about expenses largely in regards to fund expenses and deductibility, we're often talking about the accounting fees, the borrowing fees, all those sorts of things, but remembering that expenses of a capital nature, so acquiring the asset, have an impact of the fund as well, and so we need to take that into consideration when working through all of these sorts of scenarios with our clients. So again, that's in draft format. The consultation period closed in July. As I said, the joint accounting bodies got together and put a joint submission in about this measure. The SMSF Association were one of those parties. They also put in a separate submission where they did talk about this unintended consequence of the way that the law has been interpreted. So hopefully we see a reasonable outcome come out of that situation. If we then go on and look at legal expenses, so some legal expenses are going to be covered by specific deduction provisions. And if they're not covered by a specific provision, they're going to be generally deductible under the general deduction provision, except to the extent that they are effectively private or domestic or capital in nature. And so generally what we're going to be talking about in regards to here for most of our self-managed superannuation funds, and this has always been, the classic question that gets raised quite regularly in this space, is that what happens if we're amending the deed? Is that deed amendment tax deductible to the fund? And so if we're establishing a deed, then that's generally not deductible because it's going to be capital in nature. So often, the position has always been, from a fund establishment point of view, the establishment cost of the superannuation fund is capital in nature and is not deductible to the superannuation fund. However, where we've got trust deed amendments that are required to facilitate the ongoing operation of the super fund, right, then they're generally going to be deductible under the general deduction provisions, such as meeting the various legislative changes. So if you had to update your deed to allow for the changes that came in from 1 July 2022 around the work test, the contribution acceptance rules, obviously making amendments to do with potentially with downsizer and first home super saver or whatever else it might have been. And then again, more broadly, 2017 changes, even more so the 2007 changes, then those sorts of deed amendments to facilitate those operational requirements are going to be amended. And if a fund amends a deed to keep it up to date with changes to super law, the expense in doing so will be deductible. And again, there's some references in through various tax rulings over time that do talk about amendments that result in enduring changes to the SMSF structure of the function or creates a new asset. And I'm going to highlight a bit of an example of that as we go through these couple of examples. And so the first one being switching from, let me just jump back to my final point there. So what we have to be mindful of, and I referenced this when I talked about NALI before, is that the NALI amendments apply to expenses. And this was something that was not in the budget, but was in the final piece of legislation. And that is that the NALI amendments, so the 2 times factors, going to apply to expenses of capital and revenue nature. So even if we've got a non-deductible expense, it can create an issue. And so the reason I put it here in talking about fund expenses is, part of the services that Smarter SMSF provide is we provide documentation service. So, for example, if Aaron is providing that document service and he's providing it to his own self-managed superannuation fund, and he doesn't pay for the deed amendment, he effectively just replaces his deed that's currently existing. Well, there would have been no deduction on that expense. So he goes, there's no deduction, so I'm not going to incur the expense. But it's an expense of a capital nature, and he has obviously undertaken a non-arm's length transaction. So even things like the provision of documents is going to be something that we need to be making sure that we're paying or undertaking those transactions on an arm's length basis to ensure that we're not captured under the new NALI provisions and then have to apply that 2 times expense factor. Now, in talking about a deed amendment, we're talking about a cost that might be, let's call it $500 to $1,000. If we don't pay for that, we're multiplying it by 2 and getting up to $2,000 for it. Then okay, we're only paying $900 in tax, but we want to try and avoid that sort of transaction in its entirety. So we just got to make sure we deal on an arm's length basis. So yeah, to look at the difference between a couple of sort of trust deed arrangements. So the Jones Self-Managed Super Fund, 2-member fund, Tom and Mary are both individuals. Tom dies and Mary decides to change the SMSF to a single member fund with a corporate trustee, and she does this once the death benefit's been paid. So in addition to the usual fund expenses incurred in running the fund, Mary incurs the following additional expenses: the legal cost to amend the deed and change the fund to a single member with a corporate trustee, and then the ASIC fees associated with setting up the corporate trustee. So the legal expense are capital in nature because they are incurred in making enduring changes to the structure of the fund. So we're going from an individual trustee to corporate trustee. And then the ASIC fees incurred in setting up the corporate trustee are also capital in nature. In any event, they're not considered to be expenses incurred by the fund. So therefore, the legal expenses in this situation are not going to be deductible under Section 8.1. Versus in this situation, the trustees of a self-managed super fund decide the fund trustee is out of date, having been established in April 2014. It refers to super law provisions which have been repealed and to contact addresses for the trustees that are no longer current. So the trustees decide to engage a legal firm to update the deed. Again, a $500 fee is charged to the self-managed fund. As the changes are ordinary incident of the date of running the fund and are not capital in nature, then this is going to be deductible. So often I find that if you're engaging your clients to do deed updates, then the concept around why those deed updates being done, is it a necessity or is it an aesthetic type thing? So if it's necessity, then we're talking about the expenses potentially being, or most likely being, deductible in that instance. So they're our kind of general ongoing expenses that we see coming up on a regular basis: deed amendment, deed appointment and removal type expenses, fund investment related expenses, and all of these things do have potential links to non-arm's length expenditure that we need to be mindful of with regards to the operation of superannuation funds. I want to then also now touch on insurance and other deductible expenses of the fund. And insurance is certainly one of those areas that I know myself. I've spoken a lot about over all of my years of presenting with regards to the holding of insurance inside of superannuation and what is then deductible in this space. And we saw a lot of activity around the insurance premiums and the ability to claim tax deductions, sort of stemming from the 2007 superannuation reform, and it took a life of its own there from an industry point of view, where it took probably 4 to 5 years before we got some clarity and certainty, particularly around total and permanent disablement and any occupation versus own occupation. But what we know, and again, when we're talking about general versus specific expenses, is that we know that there is a specific deduction that is available for super funds in relation to insurance premiums paid for policies that are for contingent or current liabilities to provide death or disability benefits. Now, the way that the legislation is written is that the insurance policy has to be linked to the ability to pay out a benefit, and those benefits are a death benefit, a terminal medical condition benefit, and disability superannuation benefit, which is where we require our 2 medical practitioners to be able to sign off, which is slightly different to permanent incapacity. Same condition, but requires the 2 medical certificates there. But also benefits provided due to temporary inability to engage in gainful employment for a specified period. So our temporary incapacity, so it's a benefit. So we've got the capacity to claim deductions for these funds. What we will also have is funds that have old own occupation policies that are still sitting within the fund, and potentially trauma policies and other sorts of insurance policies that are held inside of super. Now, the deductibility of those policies has always been questionable, particularly trauma. So trauma has largely been one that has been a non-deductible expense. And the argument around this sort of that time frame between 2007 and 2012 was that if you had a trauma policy in the fund, then the size of the premium you paid out had to be reflected or had to be reviewed upon from a sole purpose test. Like from a sole purpose test point of view, why have you got this trauma policy in there? Because if the policy pays out, you may not actually be able to pay the benefit out of the superannuation fund. So it just had this whole bad smell about it with regards to the fund. And so what happened through all of this change at that time, The regulators and Treasury released a number of documents. The legislation was updated, the regulations were updated, and they provided us with this TPD chart, ultimately, that determines the proportion of our premiums that are actually deductible. So we notice that we get our TPD with any occupation is going to be 100% deductible, and then any occupation with the other conditions associated with it are going to have an element of deductibility as well. And then you've got your different levels of deductibility linked to your own occupation policies. Now, you can't commence a new own occupation policy in the fund now because of the way that the legislation was written 10 years ago. So you can only trigger any occupation because of the link to the disability superannuation benefit definition. But for those legacy policies in the fund, you can rely on these percentage factors to determine how much of the premium is going to be deductible from an expense point of view. You can also go and get an actuary to determine the actual percentage, but obviously that incurs an additional cost, and so most people are going to rely on this specific deduction process as it goes. But if we take the insurance and death and disablement deduction that little bit further, we've also got, and for those of you that have heard me present on this sort of topic before, we've also got our future service deduction. And this gives us the ability that instead of claiming our tax deduction on insurance premiums during a financial year, we can instead elect to claim a deduction for the future service portion of our eligible benefits, right? So that's going to, if it consists at least partially of insurance, so this is a key, there's got to be insurance proceeds in the fund, and we had to have been claiming the deductions for the insurance premiums, and then we subsequently pay out a death benefit, a disability benefit, a terminal illness benefit, or an income protection payment, then we can look to claim this future service deduction. Now, the key to this is that it doesn't matter whether or not we pay the benefit as a lump sum or an income stream, it gives us the capacity to claim the deduction. So it's a fairly powerful tax deduction, but it also requires the fund and indeed the recipient or the person that the payment was linked to meet quite specific conditions. So as powerful as a deduction as it can be, its use is often quite limited because people don't satisfy all of the various criteria attached to it. So it's one of those areas that we need to be mindful of. Now, what needs to happen is in the year that we intend to claim it, right, we make an election to claim for the future service deduction instead of claiming the annual premium. So we can have a situation where for 20 years we're traveling along and we're paying insurance premiums and we're claiming the tax deduction, and then the member passes away or a disability benefit or a terminal illness benefit occurs, right? And in that year, what we do is we make the election to disregard the premium and instead claim the future service portion of the benefit that is paid. The consequences of that is it's irrevocable, and therefore it applies to all future years. So once we've made that election inside a self-managed super fund, right, then we've got no capacity in the future to claim a tax deduction on any insurance premiums paid, which in respect means that as a deduction, it almost makes it an exclusive deduction for funds like self-managed superannuation funds, where you might only have one or two members in the fund, because the size of the deduction that we can generate through this might be significant that we don't ever need to have the ability to claim the future premiums from an insurance policy point of view. So it often is highlighted as being quite an exclusive deduction from an SMSF point of view. So let's work through a bit of an example to see how this works. We've got Michael, and he's got a life insurance policy of $1 million. Well, the self-managed super fund has a life insurance policy of $1 million for him, and he's been paying premiums each year since the fund was established in 2012. So his eligible service period, he started in 1995, passed away in October 22, aged 45, with the life insurance proceeds placed into the fund. Death benefit, of 1.3 million was paid in November 2022. But now, fair chance that there's very unlikely, should I say, that we're going to have a death in October and a payment in November. But for the set of circumstances that we're dealing with, we're talking about a payment that occurs in the same financial year. So we do need to be mindful of how this all actually operates from a timing point of view. So we need to make sure that we get that payment in the year, because there had to have been a premium paid for us to be able to elect not to claim on that premium. So the fund minutes of meeting held, the trustee decided to claim a deduction under 295,470 instead of claiming the insurance premiums. And as highlighted before, or highlighted through various things that the ATO released, it doesn't prescribe a limit as to when that decision is made. So basically, as long as the decision is made before the lodgement of the superfund's tax return, then that's going to be okay. So in the 22-23 year, if we're lodging that return in, say, May 2024 would be the lodgement date for that, then as long as that decision is made prior to that point, then that is going to be acceptable. So then if we look at the mechanics behind the calculation and behind the deduction and how it all works, we're going to get a deduction here of basically $500,000. So we've got a date of birth of 1977, gives us age 65 at 2042. Now that's important because the way that the calculation is based is it's based on the benefit times the future service days, and future service days is date of death or date of disablement right up until your 65th birthday. So it's only a relevant deduction if the member passes away or has the event occur pre-65. So we always need to know that future service period. We need to know the date of death, and we need to know their start date. So we need to know their eligible service period of 1995. So we've got our future service days of 7,000 odd dollars. We've got our total service days of $17,000. So when we do the calculation, we multiply our $1.3 million, which is the sum of the insurance plus however amount is in the superannuation fund at that time, times that by the future days, the 7,000 divided by the total days, gives us that deduction of 537,000. There's a couple of key issues associated with that, and I'll go through a couple more in a moment. But one of the things is that if you pay out an insurance benefit to a non-tax dependent, so if you're paying it out to, say, an adult child, then we have to have an appreciation that there's going to be an untaxed element calculated. Now, often what is advertised is that claiming a future liability to pay benefit deduction, right, the future service deduction, will result in an untaxed element. But that's not the full truth, because even claiming the premium-based deduction is going to result in the calculation of an untaxed element if you've got a death benefit payment to a non-tax dependent that incorporates the insurance proceeds. So in many instances, to get this larger tax deduction, if you're going to have to calculate an untaxed element, then you at least get a better tax position for the superannuation fund. So the overall tax position is going to be better. So it's one of the things to be mindful of. But there are a couple of important things, as I said before, in addition to that concept of the untaxed element to be mindful of, and that is that because it applies to the payment of a super death benefit or disability benefit or temporary incapacity stream, there's a requirement that the payment is as a consequence of the termination of employment, right? So given that it's as a consequence of termination of employment, clearly the person had to have been employed prior to the event occurring for the fund to be entitled to claim the tax deduction. And then there has to be some form of link that the disablement resulted in them ceasing work. Obviously, death is going to result in them ceasing work, but there has got to be that link there. And TR 2003-13 does touch on this concept of in consequence of, with regards to the termination of employment. But again, if you've got somebody who's not working, if you've got a non-working spouse with insurance and they receive the benefit, then there's no ability to claim this future future liability deduction. As I said before, it's only eligible up until the age of 65, and once made, it's irrevocable, meaning that we can't claim future deductions. So for premiums. Now, one of the things I would say in regards to this is ever since the transfer balance cap was brought in 2017, and a lot of members now have pension and accumulation, the benefit of the deduction was often lost if the entire benefit of the fund was transferred into an income stream. So even though I said before you can pay the benefit out under lump sums or under pensions, it was somewhat pointless a deduction to pay out if the entire fund moved into pension mode. But given now, one, that we've got the capacity to have up to 6 members in a fund, but members with a transfer balance cap greater than, or total super balance greater than the general transfer balance cap, means there is that more often than not that pension and accumulation interest, and so there is the ability for funds to retain the deduction to offset the tax on the accumulation, and it's further enhanced by the ability now to roll over a death benefit pension. So, in instance, if you had a multi-member fund and you had a death benefit income stream that was commenced and accumulation interest, then you could claim this deduction and roll the death benefit pension member to another interest or to another fund, and just maintain this deduction for the accumulation member. So there are a number of things that you can factor into the decision. Now, again, I do highlight that as a subject matter, we talk about this more than I see it applied, but I've certainly seen it applied inside the super environment. Now I do have a question, so let me just cover off on that now. So for the future service deduction, what if the death benefit only paid out 1 year after the member's date of death? Should the SMSF claim the deduction in the year of death or the year paying out the death benefit? Okay, so that's a really good question, because what really has occurred is that the key is that in the year of the payment, you're not you're making an election not to claim the premiums. So what that actually means is that once somebody has died, and this is where the timing of it can be quite interesting. If somebody's died, and let's say they die at the very start of the financial year, and they notify their insurer, and therefore the insurance premiums cease straight away, and there is no premium paid in July, and the death benefit's paid in that year, you can't make the election, because you can't make an election not to claim on the premium, which is part of the 295/470 requirement. So same would occur as if somebody dies during the year and they've been paying the premiums that year, but the death benefit itself is not paid until a future year. Then in that future year, the premiums would have ceased and there'd been no premiums in that year. So you can't. So basically, you have to have everything occur within the one financial year and have premiums have been paid for the fund to have the entitlement to the deduction. So that's just something to be mindful of, that the timing of it can certainly be problematic for the fund. Collectibles and artwork. So as I said before, just to touch on these, we have our rules in place since 2011 that require such things as storage and insurance. So our insurance costs for artwork and other collectibles will be deductible to the fund, provided the items are insured in the name of the fund within 7 days, and that we've got our receipts and everything is done in the name of the superannuation fund. And then our storage costs for any artwork and collectible are also going to be deductible. So if we're storing these assets, we need to be very clear as to why we have to have a written statement as to why the assets are being stored. But again, those expenses are going to be deductible to the fund. So what I want to sort of round out and finish off today's webinar with is, before summarising everything, is just talking a little bit about the apportionment of fund expenses as well. And as I said, I sort of have flown through a lot of these issues relatively fast paced, because it was really about identifying what sort of expenses can be paid, and then whether or not they're deductible, but also then linking things into the non-arm's length expenditure nature of transactions as well. But at the other end of the scale, so if we forget non-arm's length expenditure and we start to talk about exempt current pension income deductions for the fund, then we need to have an understanding that that not all of the income of the fund in an ECPI environment, not all of the income of the fund is going to be taxable, and so therefore, in certain circumstances, not all of the expense is going to be fully deductible to the fund as well. So, as said there, where an expense is deductible under the general deduction rule, the expenditure is deductible only to the extent to which it is incurred in producing the fund's assessable income. And so if we've got exempt income, we don't have assessable income. So where the expense is incurred partly in gaining or producing assessable income and partly in gaining or producing non-assessable income, such as ECPI, and the fund can identify a distinct and severable part devoted to gaining or producing assessable income, then this is the part of the fund that the fund should be claiming as a deduction under the general deduction provisions. So if you can clearly split your expenses between assessable and non-assessable income, then it's quite easy to determine the deductibility. But as most of us will know and appreciate, in most circumstances, that those expenses are not split so easily. So if we look at this example here, we've got the SMSF trustee appoints a property managing company in respect of 3 investment properties held by the fund. One of those properties is a holiday rental home and is managed by the company's regional offices. The holiday rental property is also a segregated current pension asset of the fund, so the income derived from this asset is exempt. Okay. Now, again, that in itself is, it's becoming more and more rare that we're actually seeing investments, particularly property investments, segregated to asset or to pension investment pools. But it is possible. But obviously, we need to see that if we do have that, then potentially this sort of example can apply. The company charges the fund $2,000 for its services, but the invoice identifies $500 of that amount as being the cost incurred by the regional office for managing the holiday rental home. So the amount of $500 can be distinctly identified as a cost incurred in gaining the fund's exempt income, while the remaining $1,500 can be distinctly identified as a cost incurred in gaining the fund's assessable income. So the fund could claim the amount of expenditure being $1,500. So that's kind of the simple approach when we've got a scenario where items or expenses are clearly identified or separately identified. If you've got multiple investments and you've got ECPI-based investments as well. Otherwise, because a lot of expenses can't be divided between that distinct and severable element, such as, and again, we've got the example here of auditor fees, but administration fees, so all your accounting fees. So because they can't be split this way, as the expense doesn't relate in any particular way to either fund's assessable or non-assessable income, in such cases, then the fund has to estimate, and we have to do it in a fair and reasonable way, how much of that expense was incurred in producing the fund's assessable income. So to do that, again, we go back to our effectively our expenses Bible for self-managed superannuation funds, which is TR 9317, and that ruling provides guidance and examples as well on what the commissioner can accept as a method of producing a fair and reasonable outcome. And what I would generally implore people to do, particularly those that operate in the accounting space and the preparation of fund returns, is to certainly clearly look at both methods that are available to do this. And I'm primarily going to focus on the actuarial method here today, but to look at both methods, because there's going to be certain circumstances where one method will provide a better outcome than the other. But I would expect that most of our SMSF softwares out there rely primarily on the actuarial base factor, and so you would need to have the capacity to override that if you're going to go down the other path. And if an expense is deductible under a specific deduction provision, then the wording of that provision will indicate whether the expense must be proportioned and on what basis. So insurance, for example, does not need to be apportioned, so the expense remains fully tax deductible. So in this instance, again, we've got a self-managed super fund. We've got both pension and accumulation members, and we don't segregate the fund assets. So the trustee obtains their actuarial certificate to determine the proportion of the fund's income that is exempt current pension income. And the actuary certifies that 45% of the fund's income is exempt. So the trustee of the SMSF engages an accounting firm to undertake admin functions. The accounting firm charges $1,500 per annum to do the annual returns, lodgement of the annual returns, arranging the annual audit, preparing the member statements, and then the preparation of reports on the fund's investments. So the $1,500 is not calculated according to the cost of each particular service. The expense, therefore, can't be easily divided into distinct and severable parts. So the trustee decides it'll be fair and reasonable to use the exempt income percentage as certified on the actuary certificate to determine the proportion of the accountant's fees that is deductible. And in this instance, they would do the calculation as 1,500 times by the difference, so 100% less the 40% equals 900. So therefore, the result is a portion of 900 that can be claimed as a deduction by the self-managed superannuation fund. So that is the simplest method from an apportionment point of view, and most funds will apply that. As I said, a lot of the softwares will just automatically apply that approach. But then there is a further option within the ruling which talks about you take the calculation of the assessable income and you add in or you subtract non-assessable contributions and other things, and it can actually result in better outcomes for certain funds, particularly funds where you've got pension and accumulation and contributions in the same time. It may provide a better outcome, but again, for most funds, this is going to be the general approach that they take. So how I want to sort of summarize it all today is that I've given you a bit of a broad scope of the expenses associated within the fund, and particularly, the expenses around investments, and then therefore the deductibility associated with it. You've got to consider the nature of the expense to determine whether a deduction is allowable. So when we're talking about legal expenses, is the trustee change for an enduring purpose from a change of the structure from individual to corporate, or is it to keep up to date with the legislation? And that's going to determine whether or not we have the capacity to claim a tax deduction. Understand the different insurance policies and the level of deductions allowed under the premium. So again, this is an area that has been simplified greatly over the last 10 years or from 10 years ago. But we still might have funds with these legacy insurance policies in there because there was no requirement to remove those sort of pre-2012 trauma policies or pre-2012 own occupation, but also things like self-insurance. Previously you had, prior to 2016, you had the ability to claim a tax deduction for self-insurance reserves held within the fund. Now all of those sort of mechanics and opportunities have disappeared over time, and so now from a premium point of view, you've really got your deductibility for death, income protection, total permanent disablement, and terminal illness. Beyond that, there's nothing deductible. And then when we're talking about those policies, is there a capacity to claim under the future service deduction? Now, arguably, I would say that because terminal illness, death, and TPD, the deduction's based on the benefit you pay out, then it is a worthwhile deduction to contemplate. With regards to income protection, then you're only claiming the deduction on 1 year's worth of income, and so to me it would seem a little bit less beneficial to a fund to do it for income protection purposes than under the other opportunities that arise. And then apportionment may be relevant with various expenses, and when we're in ECPI environment, and so it's just applying the appropriate apportionment method that you choose that's potentially going to provide you with the best outcome. And then make sure, if you are claiming any expenses, that they are supported with evidence from an audit point of view, particularly when we're talking about fund expenses largely that are investment related. So when we're talking about anything to do with property developments or property improvements and those sorts of things, that if there's any expenses that the fund is paying out, that we can then subsequently justify. And I particularly think in this new non-arm's length expenditure environment, the justification and the proof are going to be key issues for probably a period of time, whilst auditors and administrators get their head around making sure that everything's done on an arm's length basis. So they're key issues that I'd certainly be mindful of. So look, thanks very much for joining me today. Just to give the heads up, the next two webinars that I'll be delivering for SuperGuardian on the 16th of November is on SMSF benefit payments. Then on the 14th of December, we'll do SMSF windups. On the 15th of November, Smarter SMSF, we're delivering an SMSF masterclass on contributions. So you can always jump on our website and have a look at that as well. And they're 3-hour online sort of interactive webinars that we undertake. So by all means, I'm more than happy for you to jump in and have a look at those as well. So look, thanks for joining me. Having a look, there's no more questions. So thanks very much, and I look forward to seeing you all in November. Thanks for that. See you.